Hello and welcome. I'm Jeffrey Mishlove. Today we'll be exploring empirical research using news-based indicators. My guest is Peter Hafez, who is the director of Quantitative Research for the data provider RavenPack. He has an extensive background both in the financial world and as a researcher with Sir John Cass University and Business School in London. Welcome, Peter.
So we have now, can you say, just published another paper. I believe it was last week, where we took these country sentiment indicators and looked at them more from a relative perspective instead of looking at when, can you say, short-term sentiment in the U.S. Was more or less bullish than long-term sentiment. We actually look at creating, let's call it a euro-dollar indicator. So you would look at the ratio of sentiment between the Eurozone and the US and see whenever, can you say, the Eurozone, relatively speaking, had greater sentiment than the US. So whenever you saw an improvement in Eurozone sentiment relative to the US, that would be a signal. You would signal you would create a trigger and trade the euro dollar. What we found was that when there was actually a short-term reversal effect, but a long-term momentum effect trading these indicators. So, for instance, if you saw that the Eurozone sentiment improved over can you say, today relative to the US, there would there tend to be an overreaction to that news or that sentiment, and therefore you would see a rebound, can you say, the following day. And that has been extremely or very, can you say, a quite robust result. It's something that we tested it back to 2004 and has worked very well with, can you say, information ratios of about 1 with this after transaction cost, by the way. I should probably point that out. After transaction cost, an information ratio of about 1 over that 9-year period. Likewise, we took, based on the same information, same indicator, we took a strategy that had a 1-month investment horizon. So we still made daily decisions, but whenever we made a decision, sorry, we took a monthly investment horizon. So in effect, we created 30 independent portfolios, one for each day of the month. And then we averaged the strategy performance across those, let's say, 30 portfolio paths. And by doing that, we were able to generate a strategy with an information ratio of about 1.6. So it did extremely well. Again, performing very consistently since 2004. We are currently, can you say, working on rolling out this type of relative sentiment indicator into other currency pairs as well.
Mm-hmm. Well, all of this is very impressive. It's a large body of research in a new and an exciting area. Do you have any sense when you publish your results with these trading strategies if the very act of publication is going to end up weakening the effect?
I think as with any other signal, the more that kind of jump in the game, of course, the value of certain signals will diminish. That's kind of a given. And you can say that some of the, can you say, more of the simpler, the more simple signals have probably are more difficult to capture today than it was, let's say, 3 years ago. Especially when you look at the large cap universe where some of the big guys have started to move in on. That being said, we are still finding value when you start to sophisticate your signal, right? So when you start to build more sophisticated hypotheses around how the market reacts to news. So for instance, looking at a traditional reversal signal, looking at whether that is possible to enhance if you overlay it with media attention. Saying, do we expect, let's say, a reversal to be stronger. So typically, just to explain, a typical way that people could trade is, can you say, reversal signal is by ranking companies according to how much the stock price moved over the last week. So you will end up having a universe of winners and a universe of losers. And typically what you see is that they tend to revert over the following 1 week period. So those that were winners over the past week tends to be losers over the coming week. Those that were losers tends to be winners. But but some of this may, so this is, can you say, a very crude way of doing it. What we are arguing is that you may be able to create a stronger signal by overlaying it with media attention, saying if the stock price moved with news, it may actually not revert as strongly as if it didn't move with news. So if it moved with news, there may be a very good reason for this big price move, right? And the price might be more sticky. But if it didn't move with news, it may have been caused by more market behavioral elements. So, for instance, one of the big asset managers having to rebalance his portfolio or something like that, right? Just to name something that could be have driven prices. And given that it wasn't really supported by any changes in fundamental news, you may actually see a much stronger reversal. And it's actually a study that we're conducting now, so it's not taken out of thin air. It's not been published yet, but we are basically finding this type of result. And so that's quite interesting.
And that would be, incidentally, from my reading of the literature, consistent with some other studies that have already been published.
Yeah, there was a study that looked at something similar done by Tedlock, an academic that did something a few years back, and he found something similar. And there's also been, Deutsche Bank has a report out that has kind of pointed to the same kind of finding. That's correct. So you're definitely seeing these type of effects. We are also in our study, on top of that, adding sentiment in there, and seem to find some interesting results there. So, for instance, if the stock price was a loser last week, and you saw a lot of news, it's actually also interesting to look at whether it was negative or positive news. So, if it actually dropped and it was positive news, you are actually more likely to revert than if it was negative news. So you could still see, can you say, a reversal effect even though you had news if the stock price moved against your sentiment. So in the end, you can create significantly stronger signals, and we're talking about, let's say, a factor 3 in terms of returns that you can get by filtering more aggressively your universe and trade. Can you say some of these these enhanced reversal signals? I believe you just also to kind of get back to the question about when more people start trading this, there are definitely some signals that seem to be less strong than they used to be, but there's not, can you say, strong evidence right now that it's because more people are actually trading the signals, because you can see time periods in which certain signals are just stronger than others. Typically, negative signals are very strong, negative sentiment signals, and therefore, when you go through crisis periods where you have a lot of negative news, new sentiment is a very, very strong signal to trade. And if you go through positive periods where there's more positive news, well, on average, you may see a signal being, can you say, less strong. But some of the interesting things that we have noticed recently, and why we're saying that there is a lack of strong evidence, is that even though you may have seen, can you say, most recently that for large cap stocks that the signals are still there, but you need to trade it on shorter horizons. So it's not, can you say, over a week, or over a month. It may be within a week, within a couple of days, and for some you may even need to go intraday. If you trade it as a simple signal, just here's the sentiment, let's make a decision. You have actually seen that for some of the mid cap to small cap range that the signals have actually now last for longer than they used to. So it's kind of it's not very clear whether what's driving it, whether it's the market environment that has just impacting, the interpretation or the impact of the signal, or whether it's really about more people trading this.
Well, it sounds like there's many research opportunities still exist to kind of get to the bottom of when the signals lengthen, when they shorten, or I should say cycles rather than signals.
There's lots of things. I would say I tend to say a little bit of a joke that you could make a career out of it. And I'm glad you can. I have. I tend, I always start off with a list of, let's say, 5 things I want to research, and before I'm done with my, covering just one of the topics, I have 10 new things I want to add. And there's no doubt that academia, if we talk about that, they have really picked up on this. And there will be a lot of academic research coming out over the next year or two. We have signed up a lot of academic clients that can you say research our data. So there should be lots of interesting stuff coming out. And there's some of the things that we're hearing in the marketplace right now when it comes to from academia, that our new global macro product was also a first in the market with detecting events and sentiment, etc. on all of these different entities. They kind of say to us, we really want into the game now. It's kind of a gold rush. They see it as being the next gold rush because it's a new data set and they want to make tenure. There's really a rush here to try and get these to make a name out of themselves in a new space.
Well, Peter, I'd like to thank you very much for your time and all of the information that you've shared. It's very exciting, the work that you're doing, and I'm happy to be able to share it with the audience of people who will be able to watch these videos on the internet. I hope that we can come back and do this again sometime.
Yeah, definitely. I'll be happy to.
Thank you very much.